Hello, savvy investors. It's the Dividend Uncle here, embarking on a new chapter in our investment journey. With the market reaching unprecedented highs in 2023, I've made a pivotal decision. I've sold my S&P 500 ETF and am now on the lookout for a safer way to invest in the US market. Why, you ask? The S&P 500 soared by 24% last year, pushing its price-to-earnings ratio to a staggering 24.2 times, largely thanks to the Magnificent Seven: Nvidia, Apple, Microsoft, Alphabet, Amazon, Tesla, and Meta. These giants drove about 75% of the market's returns. While the returns were great, the diversification that I sought for investing in S&P 500 ETF has been significantly distorted. The Magnificent Seven now make up about 30% of the S&P 500 ETF and 50% of the Nasdaq ETF, with valuations soaring to 33 times earnings. This dominance has shifted the diversification landscape, making these ETFs riskier bets for 2024. Many investors have raised concerns about future performance replicating that of 2023 for these traditional ETFs. So, what's the game plan? It's time to explore 3 safer investment strategies that offer a more balanced exposure to the US market. And, I'll reveal which strategy I'm betting on for a smarter, safer investment in 2024. If you're keen to navigate these shifting tides with me, let's dive in. RSP, assured diversification via the Equal Weighted ETF. First up, let's talk about RSP, the Investco S&P 500 Equal Weighted ETF. Unlike its market cap weighted counterparts, RSP gives each company in the S&P 500 an equal slice of the pie, with all stocks weighted at about 0.2%. This method ensures that the investment is not disproportionately affected by the performance of the largest companies. Why is this approach safer? It diversifies risk more effectively, reducing the impact of any single company's downturn on the overall portfolio. It offers exposure to the broader market's potential, including mid and smaller cap companies that might be undervalued or have higher growth potential compared to their larger counterparts. Looking at its recent performance, RSP has shown promising returns, with a 5.0% increase over the past year and a 9.1% increase over the past 3 years. These figures are especially noteworthy considering the current market dynamics, where a handful of tech giants have dominated traditional indices. Investing in RSP means betting on the entire market rather than a few overvalued stocks. It's a strategy that believes in the collective strength of the S&P 500, making it a safer, more balanced way to tap into the potential of the US stock market. Moat, investing the Warren Buffett way. Next in our lineup of safer investment strategies is Moat, an ETF by Van Eck, that zeroes in on US companies boasting a sustainable competitive advantage, or, in Warren Buffett's terms, a wide moat. This ETF selects firms that are not just market leaders but possess enduring qualities that safeguard their long-term profits and market position. Moat has demonstrated commendable growth, with a 1-year annualized return of 15.8% and a 3-year annualized return of 11.8%. Such performance indicates that companies with wide moats are not only resilient but also capable of delivering superior returns, even in fluctuating markets. One of Moat's distinguishing features is its diversified approach to holding concentration. The top holding in Moat accounts for less than 3% of the total fund, which minimizes reliance on any single company and spreads out investment risk. Noteworthy names within Moat's portfolio include Salesforce, Disney, and Wells Fargo, each a leader in its respective field with a clear competitive edge. Rounding out our trio of safer investment avenues is DGRW, the Dividend Growth ETF by WisdomTree. DGRW offers a nuanced take on the US market by concentrating on companies that not only pay dividends but have a history of consistently increasing them. This strategy is a testament to financial health, operational efficiency, and a commitment to returning value to shareholders, indicative of companies that are not just surviving but thriving. These are businesses that have demonstrated the ability to grow their earnings in various market conditions, a sign of enduring competitive strength. DGRW has stood out with a 1-year annualized return of 16.3% and a 3-year annualized return of 12.5%. These figures suggest that a focus on dividend growth can indeed parallel, and sometimes surpass, broader market performance, offering a compelling blend of income and appreciation potential. Unlike the equal weighted ETFs, DGRW provides exposure to some of the Magnificent Seven, including Microsoft, Apple, and Nvidia, within its top 10 holdings. This inclusion bridges the gap between seeking growth through tech giants and maintaining a diversified portfolio grounded in dividend growth. For investors, DGRW offers a balanced approach, exposure to high-growth tech stocks while maintaining the safety net of dividend growth as a marker of stability and quality. The Dividend Uncle's take. Let's dive into which ETF I'm choosing for my US investments, especially when things look pricey. We talked about 3 good options, but I've got a favorite, MOAT. Here's why I'm picking it for my growth and opportunity part of my portfolio. MOAT is all about going for the best companies, the ones that have a special edge so they can keep winning in the market. This fits just right with how I like to pick my investments. I always look for quality. Since these companies are strong and steady, putting my money in MOAT feels safer, especially when prices in the market are really high. For anyone investing, MOAT is like getting a piece of the best businesses without worrying too much about the ups and downs of the stock market. Now, about fitting MOAT into my investment plan. In another video, I talked about how I spread my investments across different types, like REITs, dividend stocks, growth opportunities, and bonds. Each type gets an equal share of my money. Today, we're focusing on the growth part. And adding ETFs like MOAT is a smart move for making my US investments stronger and more varied, even when the market's at its peak. So, I'm excited to start adding MOAT to my portfolio bit by bit in the next few months, in typical The Dividend Uncle style based on dollar cost averaging. It's not just about staying safe in a highly valued market, it's about smart growth for the long haul. Conclusion. That's it for today. Let me know whether you are investing in the US, and if so, how you intend to invest in 2024. If you found these insights helpful, give us a like, subscribe, and share your thoughts in the comments below. Until next time, keep investing smartly and stay diversified. This is the Dividend Uncle, signing off.